Okay, so in the previous video clip, we took a look at these long future contracts, and we actually compared futures. So the futures position, we compared to forward contracts. So we made a comparison between the futures and the forward positions. And we pointed out that futures contracts typically trade on exchanges, whereas forward contracts trade over the counter or broker to broker. And the futures contracts are standardized, and that creates a lot of benefit because you can compare the price of a particular commodity like wheat or oil or lumber over a specific period of time. And because the contract is standardized, it means the quality is also quite constant, and you can make those direct comparisons. With forward contracts, it's more difficult to make direct comparisons between different types of wheat that's bought and sold, and then over time, simply because you cannot guarantee that it's always the same type of wheat or the same type of lumber, or the orange juice has the same level of acidity and so on. So that's why standardization on exchange traded on CBOT type contracts or CME, Chicago Mercantile Exchange, if we have an exchange that specifies very minimum requirements, very minimum criteria for satisfying delivery, then we can make these comparisons, and that then yields a lot of data points and a lot of information. Nevertheless, you still would want a forward market, because the forward market is, in some respects, it's less formal. And there are some commodities that are quite valuable that may not meet conditions specified and that are standardized. You might have an inferior quality of coffee that you may wish to sell, or you may have a superior quality of coffee bean that you would like to sell, and you would like to do it broker to broker, right? And in that respect, forward markets actually are very important, right? Future markets offer a lot of information. Forward markets offer a lot of flexibility, and the two go side by side, work in harmony. Then we were considering the payoff structure. Again, that's worth recapping. When we look at a forward contract, long forward position, the payoff, the value of that contract, so the futures contract value, right? The futures contract value can be expressed as the futures price relative to the exercise. And remember, over time, when we set up a futures contract, we have the current time period and then the maturity. And that could be 1 year, could be 6 months, could be 3 months, could be 1 week. But the futures price and the spot price of the same asset tend to, over time, tend to converge, right? So you see the two aligning once we hit maturity. Once we get to that point where we've reached maturity, then the spot price and the futures price are one of the same thing. Okay, so what's the payoff then in the futures contract? The payoff, we'll describe as pi, maybe the profit, is equal to the futures minus the delivery price. Okay, so K here is the delivery price. And if we agreed today to buy oil at $100, so we set if F is equal to 100, and we lock in that price, so we get a K then also of 100 set up today, July 2020, for delivery in July 2021. Then if the futures price and spot price move to 150 over that period, then we can buy today, we can buy at the maturity, the oil for 100, even though in the market it's costing 150. And that produces a positive, it's like a savings to the holder with the long contract. Now, the person with the long contract may not necessarily want to buy oil and have an end use for that oil. Could be that this person, I mean, if we look at the motivation here, the motivation for entering into this may be related purely to speculation. So many people are involved in the futures market who are purely speculating, who are purely taking a position. And there are other individuals who may be arbitraging. In other words, they are considering taking a position in the market because they see some kind of mispricing, and they say, look, one market is trading at 100, there's another market trading an equivalent product for 105. We buy in the cheap, we sell in the more expensive, and we take a profit of 5. That's an arbitrage opportunity that traders also are involved with. And the motivation could also be here purely to hedge. And to hedge just simply means that we are perhaps an end user of the underlying, an end user. You could be an airline, you need oil, and you want some certainty about the future. You're concerned that oil prices can spike over time, and you want protection against the oil prices jumping in value. And it's purely as a form of insurance that you're taking a hedging position, and it's a long hedge position. So again, the motivation here for entering into the long position could be you're speculating, could be you're arbitraging, or it might be that you're hedging. If you're hedging, it's like purchasing insurance. If you're speculating, it's where you believe you know more than the market, or that 9 times out of 10 or 6 times out of 10, you predict correctly the movement, the directional movement in the market, and you can profit from others not pricing correctly or forecasting correctly. Okay, now for every long position, there must be a short position, right? So if somebody is long, there must be somebody who is short. In other words, if somebody is buying, there must be somebody who obviously is selling. And the seller here, their motivation, again, can be put down to either speculation, arbitrage, or hedging. But you're hedging against what? You're hedging with the short position. If you are hedging, that's what your motivation is, you're possibly concerned that the price of the underlying oil could drop in value, and that you want to be compensated if the price falls. So it could be you're a company like BP and or Exxon, right? And you are producing oil, and you're concerned that the price might fall over a given period of time. So in that instance, we've got to think of a timeline. Again, we could go with our July 2020, and you're going to deliver the oil in 2021. You've certain costs that you're going to incur in terms of excavation and mining and so on, excavation and drilling, and they have to be absorbed, labor costs. The problem is, what will be the price of that oil when you're delivering? And what the futures or forward contract allows you to do is gain certainty. So you can say, let's set that delivery equal to a specific price, 100. So K is the constant, it's the delivery price that we set out. and we can agree that today, and then the oil gets delivered in 1 year's time for the predetermined price of 100. Again, if we want to look a little bit more systematically at this, we might consider, let's call the person with the long or the buy position A, and the counterparty with the short position is B. Okay, and let's just put it into boxes here for a moment and examine the gains and losses on the position. So we can go with A, right? And we can look at A's position. So we have A and we have B. Now, if it's a futures contract, then in between the two, there is a futures exchange that is intermediating between the two. But we may just have a forward position where there may not necessarily be intermediation between the two. Typically, in a more kind of modern setting, with the arrival of Dodd-Frank, 2010, and then in Europe, the equivalent or analog is the European Market Infrastructure Regulation. I think that was finalized 2012. They lay out very specific means for trading, and they very often, if you're trading OTC, you must have a centralized counterparty that sits in between A and B, the two counterparties. And they look after, they manage certain aspects relating to credit risk and even operating margin account. But let's, for the moment, just keep this analysis simplified. We don't allow here for a centralized counterparty or a forward exchange. We just look at A and B's position. We just allow, in this instance, that there's an A and that there's a B, and that if we want to look at the relationship between the two, we want to look at the relationship between the two. A agrees to pay B $100. That's the current time period is July 2020. The delivery date is 2021, so that's when the oil comes back. In 2021, July 2021, B will deliver oil to A and receive $100. And that's what's happening in July 2021. Okay, the agreement is set up here, but the actual exchange of oil for oil and the money occurs in July 2021. Okay, so under what circumstances will A gain here? Well, if the price increases, right? If the price increases, A receives, B receives the 100, right? And A receives the quantity of oil, the 1 barrel of oil here. So A is getting, knows in advance that they will receive the oil for $100, even if over the intervening period, the price of oil goes up to 150, right? A can still receive the oil for $100. And that's, we would consider a savings, right? That's a saving from emanating from this contract, this long position. Now in B's case, they are locked into the agreement. They must deliver the oil, right? And they're only going to get $100. So if the price over the period July 2020 to 2021 goes up to 150, the counterparty who is the short position, they lose an equivalent amount. In other words, they're locked into 100. They must sell the oil for $100. They must sell the oil for $100. Okay. And they deliver the oil for 100. and they cannot benefit even though the price in the market is 150.